If we could get the meeting started, I'd like to introduce our next speaker. This is Robert Clark from Peterson's International in Valencia, California. Peterson's International is a cover holder for Lloyd's of London. Robert has been with Peterson's International for a number of years, and he's one of their regional vice presidents and is very passionate about the products that he represents. He has had family experience with insurance benefits and is really good at what he does. So please listen to what he has to say, and I welcome you, Robert Clark.
Thank you so much, Sherry. You know, I really do want to thank Sherry Weber with DI Broker West for inviting me to be here today. Not only that, but her support of NAIFA. You know, I was honored, and then I started thinking about, man, how many people must Sherry have called to do this presentation for her to end up with a millennial carrier rep? How about that? At what point was she going through her phone and, you know, saying like, oh boy.
You're my first pick.
All right, let's go for it. And I'm like, yeah, let's do this. I got it. For those of you who don't know, I'm based in Los Angeles, California. There, I am a longtime NAIFA member. I am the programs chair for our NAIFA Los Angeles local, so I have so much respect for how much work goes into an event like this. To get 200 people in a room, it's just absolutely phenomenal. Sponsors outside. And so I want to, real quick, give yourselves a round of applause for being here, sacrificing a day of work. You know, you've literally likely gone through the snow, uphill both ways. And I'm happy coming from California, I could bring some sunshine. You're welcome. Just a quick housekeeping. My humor is very dry. My sarcasm you will probably not notice until the end of the hour, so it's going to make for some fairly awkward moments. Just like that one right there. Anyways, we'll work on it. We'll get there. I've been studying a lot of the patterns of top speakers in our industry today, legends in the insurance industry, and I've always noticed one common thread. They're always referencing and building their credibility with key technological advancements that have happened over their career. You know, quick to reference things like the fax machine and the cell phone that they finally got. That was the size of a briefcase they had to carry on their back, also through the snow, uphill, both ways. Or how about these futuristic personal computers, or as us millennials like to refer to as PCs? You know, there's been a lot of things that have happened in the course of many of our careers, and I'm kind of fortunate to say that even as a millennial in this industry, I've had a few technological advancements happen as well during my time. For instance, our good friend Mr. iPhone did not even exist back when I was graduating high school and getting ready to go into insurance. It was actually released 30 days later, so that's one thing. And you can see I have a message from my girlfriend saying, "You're going to do terrible. Probably stop." Another cool, interesting fact was every Uber when I started was a yellow Ford Crown Victoria. Usually they marked themselves with huge signs on top. You couldn't order them on your phone, so that's how you knew what ride to get in. Around that time as well, Saturn wasn't just a planet, but also a car manufacturer. I mean, I'm taking you way back, way back. But one interesting thing that I want to make light of is the fact that when I started in insurance, a little company that we all know called GoFundMe didn't even exist yet. And today that company has raised over $5 billion for clients and consumers in need, no matter what they're doing. And so as I think about an idea like that, it really forces me to think about income and asset protection and positioning, and what different things are today's consumer dealing with, or what resources do they have available that affects how we're sending messages to them and how we're helping them navigate this new form of life with all of these resources. So in order to think different, it's imperative that we all agree on a baseline. Today, I'm going to try and make this as non-statistical as possible, and our baseline is named Bob. So a lot of our messaging and the concepts I'm going to talk about today have to do with how we're talking to a prospect or client like Bob. Bob might be a somewhat average client for most, 40 years old, married, 2 kids. He's a sales executive at a company, not an owner, but an employee, and he's decent. He's pretty good. He earns $250,000 a year doing that. Your average $800,000 home, and fortunately, for income and asset protection, the one benefit his employer offers him in that realm is a $5,000 a month group long-term disability policy. And so I know many of us in this room are already seeing a gap, but I want to talk about the messaging and the repositioning of how we're having this conversation with clients like Bob. You know, through my start of field work as a carrier rep, I started going to various agents' offices and helping them understand how we can provide value to them through various products and services. And in training for this job, I spent hours, days, weeks, and months getting pushed material like this. We have products, our products have contracts, our contracts offer certain benefit amounts and certain benefit periods. And I was really struggling, actually at first I was super excited. I was like, oh my gosh, every agent probably wants to know this, am I right? And so this is part of my conversation here today about thinking different and how we change this message. Now, unfortunately for you, this is a CE credit, so we do have to go through this slide. So everyone, hang on. Get your pens out. If we're looking at the income protection industry today, here's a lot of the norms that you're going to hear about. Things like non-cancelable contracts to age 65 for our clients, meaning that as soon as they buy that contract, an insurance company cannot cancel it, and the insurance company cannot raise the rates for that individual until they turn 65. Products like that are going to require full underwriting, financial, medical, and often we can get benefit amounts up to $20,000 a month. There's some very thought-leading carriers that have done something called simplified issue. We're going to bring down the benefit limit, but make it easier to obtain for our clients by, instead of a full paramed exam, we're just going to do a telephone interview. And that works for the mass consumer. Then we have this next generation of insurance carriers offering things even like a return of premium rider, meaning that if you buy this policy and you never use it, we will refund your premium at the time that you retire. Now, I can already see in this room how many of you are like, man, this guy was off to a really good start. I laughed at a couple of his jokes. But if the rest of the presentation is like this, I think I have to go to the bathroom. And frankly, I'm just being honest. And it took me about a year into my first insurance job working with this company to be like, man, if you do this enough time to agents and advisors, they stop taking your calls. How many of you have been in your own conference room with a carrier rep and you started going through details like this and you're like, oh my gosh, get me my hour back, right? And you're not wrong. Frankly, it's the exact same, if not worse, for clients. Clients do not care about what the carriers can do or what the brochure looks like. They care about how we're helping them. And so it was through this field work, fortunately, I get to work with a lot of the top agents and advisors nationally. My business in the Lloyd's of London space specifically deals with high net worth and high income clients. And so getting to work with the agents of these individuals puts me in some really unique situations that I've been very fortunate to be a part of. And it was in one of these meetings where I discovered a very unique sales message. A producer that was finally taking these products and benefit limits and putting them into a story that resonates with clients. That is something called Job A and Job B. Now, many of you have likely seen Job A versus Job B. If you haven't, here's your first golden nugget, and it's not even really a good one, so sit down and strap in because this is about to get a lot better. Thank you for laughing. Job A versus Job B says to our client prospect, Bob, it says, Bob, you have two choices. Either you can work for Job A, which pays you $250,000 a year while you're working, and $60,000 a year if you become disabled and can't work. Mind you, that $60,000 benefit may or may not be taxable, further reducing it. Or, Bob, you can work for Job B. Job B pays you $245,000 a year, a very similar salary, but it pays you $150,000 a year if you become disabled and can't work. Now, any competent person should say what? Job B. But do they always say Job B? They don't. And so this, again, was a very similar wall that I started running into. We've taken what the carrier is offering, we've put this into a compelling story for a client to more reasonably understand, but still, it's falling on deaf ears. This doesn't make 100% sense for many clients. It does for us. So then I started to think about, okay, what is today's consumer dealing with? What is their world? What's changing in our world that is affecting how they look at a situation like this? And so instead of looking at insurance carrier trends or life insurance policy trends, we have to think about, what is Bob going through? What are the messages he's hearing? First and foremost, we know incomes are on the rise. We're among some of the top employee talent and competitiveness we've ever been in. With lowest unemployment rate, companies are fighting for this top talent. They're throwing money at it. They're throwing top benefits at it just to get the right people. So we know incomes are going up. And insurance carriers are addressing this. $20,000 a month of benefits, that covers you at $400,000 of income. That'll satisfy most consumers. But the other interesting thing is we have things like the internet and Amazon. And Amazon's a big company, yes, and they've grown, but what does Amazon do for today's consumer? I can get things faster than ever before, and I almost am certain that I'm paying the lowest price possible for that solution. Not only these two, but we have unique income sources, gig workers, 1099, freelancers. Not everyone's W-2. Even those that are W-2, many of them are earning stock awards, stock options, restricted stock units. We have thousands of startups where their founders are living off capital that was injected by a private equity firm in a Series B funding. They get their funding and they're like, I make $300,000 a year. Yeah, it's cool. And they're like, yeah, but you sold an idea and now you have funds. You can't live like that on that capital. And if you are, and if that's okay, how do we protect that as an income and an asset? These next few, I know you're all aware of. We're in a very low interest rate environment, especially when I talk to people that were former bankers in 1985 and 90, and they're saying, you know, I want to lock you into a 12% CD. I've never even seen anything like, I haven't seen a 12% 401k in a while. So that's always very shocking. You have stock market volatility, right? That's bouncing around more than we'd all like. And then for clients like Bob, we have higher education costs. I mean, these costs are going to be astronomical by the time a kid today turns age 18. I'm really praying, really holding out, that community college is the next cool thing by the time my kids are 18. And I'm waiting to have kids just so I can kind of start matching this timing a little bit better. Yeah, there's if you don't get anything out of my presentation today, that's your tip for you young professionals. And this last one, financial wellness. You know, we have so many tools, many of them on our phone, and we have so many unique things available in the financial services world. But one of the things we're dealing with is the most financially uneducated consumer that we've dealt with in history, right? As financial planners, as insurance agents, we want to help our clients understand the facts and the pros and the cons. But they call you about, hey, I want to go to Cabo, so can I pull out money? And I don't care where you grab it from, and I just want the money, right? And so we have such an uneducated economy. And what are we doing to help meet them where they are? So, with these market trends, in a job A versus job B scenario, where many of you agreed, not many clients say job B. Some do, absolutely, but not all of them. What have we essentially pressed our client like Bob to do? We've basically said, Bob, if you're willing to gamble $5,000 a year on the fact that you will become disabled, you may or may not become disabled during your working career, do you see that making sense? And the reason a lot of clients don't choose job B, it doesn't matter that 1 in 4 20-year-olds will be disabled for 90 or more days by the time they retire. All that matters when you're having this conversation with Bob is what he thinks his chances are of becoming disabled. And generally, what are those? It's not going to happen. I'll never become disabled. And so we have to think about those market trends. What is going on in our consumer's mind where this is not clicking for them? So that's exactly what I want to talk about today. So we're going to dig a little bit deeper into our client prospect, Bob, who I thought, I mean, he could absolutely be from Portland or Oregon. Do you agree? I mean, you should have seen the first guy marketing put up there, and I'm like, no. Presenting in Portland, not Hollywood, Jesus. So Bob earns a healthy income like we talked about. That nets in between $12,000 and $13,000 a month. He has about $10,000 a month in expenses, so a good savings delta there. He has a 401k he's contributing to. He has an investment account with his financial representative, and he has about $200,000 in home equity. Now, I want to challenge anyone here. What do you think is the most valuable asset on that balance sheet? Bob. Absolutely. That $250,000 income for the next 25 years supersedes any of those assets, despite him currently having $1 million of net worth at the young age of 40, which many would consider good. And so when I was thinking about income and asset positioning for this presentation today, I thought about how are we helping a client understand their grand vision, right? Tim, I love your 4 quadrants. I think that's brilliant. Because you try and have a client understand the bigger picture, right? What are we trying to do for you, Bob? The whole point is we want to work with you so that you can make the decisions today that over the course of the next 20 to 30 years are leading us to our desired end goal. Whether that's a golden egg, whether that's a business value, whether it's a combination of multiple things, rental properties, whatever the case is. We know we want to end here. And so when I was thinking of this presentation, I'm like, we're looking at a plan like this. Hopefully yours is a little bit more complicated, or complex, than four dots on a scatter graph. We're looking at a plan like this, and if Bob, and what are possible gaps in exposures? One, obviously, being if Bob suffers a disability, right? We talked about job A, job B. Bob doesn't think there's a chance he could become disabled, but let's just play it out. So what happens, Bob, if in the best case scenario, something happens relatively short term, average claim length for a disability today is 32.4 months. What happens if you go out on disability? We have $12,000 a month of income. We have $10,000 a month of expenses. But you're going to be receiving a $5,000 a month group long-term disability benefit. And so I know we can all see the shortfall there, but let's say best case scenario, Bob has a GoFundMe account, or his wife is so charged up, she's going to start that GoFundMe. We're going to put that on social media. Everybody loves my husband, Bob. They will contribute. Perfect. If we get enough crowdfunding in order to help Bob and his family through those financial expenses over the next 32.4 months, that best case scenario reflects this graph. Why? Do you think clients, family, or friends are going to help Bob fund his 401k while he's out on disability? No, so the contributions stop. And we take out that 2 to 3 years of contributions, mind you, plus the time it takes to pay those individuals back, if that's the case. What looks like the best case scenario has a $2 to $10 million difference on his ultimate plan. And so this is a gap in exposure that, again, best case scenario. Let's say if it gets worse. Let's say if the GoFundMe campaign is like 95% of them that don't go anywhere. What happens when Bob or his family has to start pulling from those assets? By the way, we all know in this room, are assets designed to be liquidated? If you have liquid assets, generally you're giving up your return on investment percentage. So we're pulling from things that vastly affect us 20 to 30 years from now. And so in the case where Bob and his family are having to pull from their assets, what might seem like a little bit of money is a lot of money. Thank you. I love your hat, by the way. I almost wore the same one, but it's hard. You know, this, you've got to take care of this. Thank you. Thank you. So, you all get the picture here. And I think if we can talk to clients about how something like disability insurance, which is probably the unsexiest word in insurance, if we can talk to them how disability insurance is not helping them from a disability standpoint, is not helping them from an insurance standpoint. We're implementing a guarantee. You see, if we have this conversation around, Bob, you know, as part of our work together and our work of creating this plan together, or if you're just an insurance agent, knowing about the plan they likely have, part of this is hoping that we can make this plan come together, right? And Bob, as you know, as much as I care about our asset diversification, our accumulation goals, tax diversification strategies, the one thing that I really like helping my clients understand are the gaps and exposures that we cannot control over the course of your career, and looking at those and implementing as many guarantees as possible. You see, on a graph like this, if we play out that job A, job B scenario, this should be the case. Bob, if I could take away the gap or exposure that we might miss our plan goals if something deteriorates with your health, would you instead prefer to purchase a guarantee that no matter what happens to your health over the next 30 years, that you will end up at that green line? Does that sit a little bit better with our client Bob? So instead of job A and job B, why don't we talk about plan A and plan B? Because today's consumer has so many tools at their disposal for fixing that short-term need, right? When we looked at job A, job B, we're saying, okay, there's about a difference of $90,000 a year from disability income, and is that worth $5,000 every year to make sure that's taken care of? No. We don't need to have that conversation with clients. We need to have conversations about, you're exposed, it's out of your control. The only thing we can do is implement this as a guarantee. And a guarantee sounds way sexier than disability insurance. I agree. So, identifying gaps and implementing solutions. This is what we want to be doing with our clients. I'm going to quickly transition. We've been talking about Bob, and Bob's an employee. But what about in the case of if someone like Bob owned a business? Is personal income protection the only thing this business owner is worried about? It's absolutely not. No. How many of those employees are counting on that business owner in order for them to put food on their own family's tables, in order for them to have the financial tools to fulfill their own financial plans, right? And if they have business partners in this venture, how do you think they'll respond to the idea of going from a long-term vision to a short-term liquidation so we can ramp up our finances and take care of a medical issue? That's not going to sit well. Same thing, actually, question here. I don't know if we have any bankers or commercial bankers. Do banks provide a waiver of premium on their loans? I didn't think so. There's not too many riders they like to attach. So if I'm a dentist and I just went all in on the building and the shop and everything's good, and it's my own hands that produce for me, but that one machine that I have clients sitting on every day or using to take x-rays was a 7-figure purchase. What happens to that if, you're right, it gets sold at auction, gets liquidated, generally not for current market value. But the idea is that every single word I just said does not contain two somewhat relevant words in our world currently: disability and insurance. It's all about how do we identify your gaps and exposures and instead implement guarantees. Guarantees that your business will thrive whether you're there or not. That if you can't show up, your house mortgage is being paid and the salary for your employees is being paid. What concerns you most about these gaps and exposures, Bob? How would it benefit you to instead have guarantees? Have a conversation. So jumping back to the employee's perspective, after looking at a business owner, we're almost excited that, oh good, my client really only has one key thing to worry about, and what's that? Their paycheck, right? And so we can implement one single thing that makes their entire financial plan stick. It allows them to continue contributing to their 401k. How many clients tell us, oh, I have long-term disability through work? Perfect. Awesome. Is it often enough? No. But they're convinced that they could get their expenses to that amount, or that they'll get by should they receive that benefit. And this one's always funny to me because I've done this personally. I'm sure many of you have. Have you ever tried to lower your monthly expenses? Have you ever been like, man, I make a decent amount of money. Where the heck is this all going? Right? And then so you're like, I'm going to go through my monthly expenses. I'm going to figure out what's our outflow here. You're looking, the big ones, mortgage or rent, right? You're like, well, I'm not selling my house, so that'll just stay. We can find some other things in here. Then you're looking at the utilities. Well, I wish my kids knew how to turn the lights off, but we've tried that, and we know that's not happening. Electricity is what it is. Same with the shower. Okay, so utilities are going to say. So mortgage, utilities, we're going to figure out all these other just extra nonsense expenses. You go, okay, internet. Holy smokes, I'm paying $100 a month for internet. My family would murder me if I got rid of the internet, right? And then so we're like, okay, we'll keep the internet. We'll keep the mortgage, we'll keep the utilities, we'll keep the internet. Oh, cable. I can totally get rid of cable. So you start doing some research, cut the cord. Which Amazon Fire Stick plays live sports? Like, none of them. Or you need a $60 Hulu subscription every month. Like, well, I'll keep the cable too. Okay, what else are we spending, right? And we go through this list and we end up being like, man, I don't know, I'm kind of used to all these little creature comforts. I'm not going to change much of this. Do you all agree? Has anyone been through that process? And so it's interesting when clients have this conversation with me and they say, yeah, I know there's a $2,000 a month delta there, but frankly, we pay for some silly stuff. We'll bring it down if we're ever forced to, because we're missing out on income. And I say, let's try and do that now. Let's see how we're going to fit your income of $10,000 a month or your expenses of $10,000 a month down to your $7,000 a month target. Let's go through the list. And if they don't want to do it with you, have them do it on their own. And then when they find, this is the best part, if they find that they can reduce their expenses by, say, $500 or $1,000 a month, guess what you just teed yourself up to do? Help them take care of an exposure and implement a guarantee. Perfect. You know where we should put that extra $200 you just found? We need to make sure that your income is guaranteed for the next 20 to 30 years. Congratulations, you just lowered your expenses and you eliminated your biggest gap in exposure. So, like I said, employees only have this one key thing that we're needing to focus on. Many of them contributing to 401k, having financial plans themselves. So it's all about how do we take this conversation about gaps and exposures, and how do we use this as an opportunity for things like financial wellness? How much do you think it would benefit employees, or frankly, even better, employers, for their employees to hear this message and to be educated? How many employers provide a group long-term disability benefit, right? Most of them? No? I loved your hat, but if you're going to keep heckling me like this, I just frankly can't continue. I didn't put in food. Well, yeah, most don't eat. So, and we have parents and grandparents that bring, I guess I was raised in an Italian family, so if I had to starve for 2 years, it'd probably be a great thing for me. They wouldn't ever let me do that. I'd probably have more food. Anyway, so with an employer and those providing group long-term disability, how many of those employees do you think are clear and concise on how much income they would receive should they become disabled? 0. None. So what if we went to employers, because we're all financially educated, we're all financial professionals, what if we offered them as a financial wellness benefit, hey, let's educate your employees and executives about the coverage you're already paying for. I guarantee you, Mr. CEO or Ms. HR, that 98% of your employees don't even know about this premium and the policy and the benefit it provides them. So how's that for an opportunity to help individuals? So what we're looking at here is a scatter graph of an employer. And it's going to have group long-term disability plan. It's going to have an individual disability plan. Maybe, maybe not. Most actually don't, because everyone's talking about permanent life insurance and not disability insurance. But after today, that is going to change. So how many of you think it'd be valuable to educate a top executive earning $375,000 a year? First off, how many people would like to have this individual as a client? Okay, thought so. And have we just identified a significant gap in exposure likely occurring for this 48-year-old who's likely tried to do some planning or maybe working with a planner? And how many financial advisors or planners are talking about proactively disability insurance? Not that many. Exactly. So to make this even better, I don't want to give you one 48-year-old $375,000 earning client. What if that person just happened to be not the only employee in that employer? What if there was a whole team of people that he interacts with daily, that he spends a majority of his life around, that were in a similar age and income demographic? How would that benefit you as an advisor to now have warm referrals around you? In a case like this is why I'm talking about employers. One of the most unique things is how we literally have a tool in front of us that allows us to be the Amazon of insurance to our clients, and not that many people are talking about it. What I'm talking about is if we can paint the right picture for a client or prospect like Bob and say, Bob, we can solve this problem. Now that we've had the plan A versus plan B discussion, we can solve this problem individually. It's going to be individual premium, full underwriting, financial and medical. Bob, would it make sense to reduce the premium for a guarantee like this and get rid of that nurse coming to your house or coming to your office, poking you with a needle, and then submitting your tax returns as well? Would you like to get rid of that whole process and bring the cost down? What's he likely going to say? Perfect. So if I say that, and I know that I can do that from a multiple life perspective, thankfully disability insurance carriers love more lives, and I know he likely works for a somewhat decent sized company, if I put two and two together, I'd say that we can utilize something like guaranteed issue disability insurance. Now, it's funny because as I got started, like I told you, when I was trained in this industry, this is what the insurance carrier gives you to take to market. You say, you call up your underwriter, hey, I'm presenting to an individual, he's an attorney, he has 6 partners. I know you do that guarantee issue stuff. Can you send me a sales piece that'll help me have the conversation or help generate interest? What do they send you? They send you this. Okay, and we're all guilty. My company still does it. So I have to be like the translator, like I'm Google Translator, right? I should make an app like that, Google Translator for disability insurance. They're going to say, well, it's guarantee issue. Here's another sales idea. We have a cost of living adjustment rider. How's that for a sales idea? If your client doesn't want it after that, then frankly, they're not sold. They're not going to buy. So it goes through certain things like this. And without getting too product-centric here, it says, if I have 3 to 5 lives or more, I'm waiving all the medical and financial underwriting requirements. I'm still offering a benefit. Income protection carriers are going from $500 a month up to $250,000 a month of disability insurance. That means a professional earning $5 million a year has the ability to get coverage at 60% income replacement. And before you say, now why would someone earning $5 million a year need disability insurance? Has anyone seen a Lamborghini driving around? Has anyone seen a wealthy client with a yacht or a plane? Do these people normally make $200,000 a year? Or more. And if you're making $250,000 a month, generally, you're pretty good at spending it. this is what's been the most interesting thing about the job that I get to do and work with a lot of these high-income individuals is seeing individuals making $2.3 million and having nothing to show for it. Nothing. In fact, more debt than income. It's absolutely incredible. So anyways, we want to eliminate that gap in exposure. I'll wrap up here. I think I'm running out of time. I am? That's like an affirmative? Okay. God, you poor people, I've just rambled. So, you've seen worse. Thank you. They're going to say, how'd that presentation go? Well, it was great. They said they've seen worse, so we're... Everyone's so excited. Okay. Only about 40 minutes of case studies, and then I'll get off the stage. I'm kidding. That's a joke. See, sarcasm won't work on it. You're still learning. You're still learning. So a quick case study. We've done an implementation like this for a law firm, 29 partners. The incomes were up to $2.78 million a year. Who would like a client that makes $2.7 million a year? Yes, we all would. Absolutely. And it just intrigues me because we know how awesome we can make a guarantee like this for clients, and yet we're all trying the latest and greatest marketing team or social media posts or anything like that to try and get us in front of good high net worth clients. This advisor identified that, hey, I've worked with one of the attorneys, or I know one of the attorneys, and I'd kind of like to have all 29 of them. And guess what? They all need income protection. There's a severe gap in exposure. I want to go educate them on how that affects their long-term financial plan. And if it makes sense, I think I can make them a compelling offer for why to do it together and why to do it today. Case study number 2. What's really interesting is the carriers that have done this outside of just personal income replacement. We had a surgeon group with 39 partners. Very quick story. One of the partners goes out on disability. He's an orthopedic surgeon. He went out on disability for 6 months. Fortunately, he had a personal disability insurance policy. His family was fine. It was at 65%. He continued contributing to his asset and his financial plan. He gets back from disability. 6 months later, he's fully recovered. He's back to work. And his fellow partners sit him down and say, okay, so here's all the overhead expenses that have happened since you left. We're transitioning you back in. And by the way, here's your $210,000 bill for your portion of those overhead expenses. Because guess what continues whether he's at work or not? The rent, the electricity, his employees, trying to reschedule his patients to other doctors, all of those expenses continue. And so even with personal disability insurance, his financial plan has drastically changed, at least taken a hit. The only way you recover from that is you change your lifestyle so you can retire on time, or you're working later. And so we brought this guarantee issue chassis to a firm of 39 physicians, and we offered them a business overhead expense policy. Completely guarantee issue, all tax deductible premiums. Marie can confirm that with me. By the way, I'm really excited I can deduct all my business entertainment expenses now that Marie said it. I have it on recording in case any of you want me to send it to you. But that was the highlight of my Winterfest. Last one, we were dealing with a real estate development company. The CEO had a $200 and something salary, but $3.7 million restricted stock unit that he was awarded every year. Frankly, his lifestyle is more reflective of the $4 million total than the $220,000 cash compensation or W-2 wages. And he reached out to his advisor to say, man, I'm making all this money. I'd really like to protect the stock options because all of my money is tied up in assets, long-term assets, and legacy planning. And if something happens, I have to tear apart one of those plans. And the advisor said, I'm not taking a 70-year-old through underwriting, and you're not going to like the price that you're going to have to pay for it. So the one thing I do know is that you're a publicly traded company. You're probably not the only one receiving a stock option. How would it make sense to make this guarantee issue, bring the premium down, and offer it to all of your executives as a financial wellness tool? And that conversation sits pretty well with clients. And so that's what we were able to implement here on a guarantee issue basis. Folks, the moral of the story is we need to be thinking different because today's consumer has so many different resources available to them. They're used to things like Amazon bringing them solutions faster and easier and cheaper than ever before. We have that capability in products like income protection and disability insurance. It's just a matter of thinking different to serve that population. Thank you so much for having me. Really appreciate your time.